I think this is an area that a lot of creditors and equity investors say, well, we've been adjusting for leases forever, right? We put a multiple on it, or we use these tables. But I think the tables you just illustrated shows how incomplete that information is. So you get the next 5 years, and then you get a residual. And by the way, this residual might go out to 2054, right? So you don't have any idea really what that term structure is and kind of where those lease payments might fall in those term structures. Which can be very important if you have a stressed credit environment. And we've seen that over the year in retail. And a lot of people are wondering, well, I need more information on the leases, and I tell them they have to wait till 2019, unfortunately. But I think the lease standard also may surprise, again, because of this incremental information. We know what's being retained here, at least under U.S. GAAP, is an operating lease component, right? And I think most investors that we've kind of talked about this topic, there's this implicit, well, what's an operating lease today is going to be an operating lease tomorrow. And I think that might not necessarily be the case. And we also have found is what I call lease creep, where certain types of contractual arrangements might not be a lease today, but maybe a lease tomorrow. And so we could see some surprises on the edges. My biggest concern, which is unfortunate, is the lease models don't align perfectly with the IFRS, and under IFRS, everything's treated as a finance lease, where again, we've retained under US GAAP an operating lease component. Now, over the long term, I understand how the economics kind of normalize out. However, the way that the presentation of this information and potentially how this information is used by investors, you may get different comparability issues when you're looking at an IFRS filer versus a US GAAP. My ultimate fear is for lease-intensive industries such as airlines, they already use EBITDA today, but that EBITDA might be applied in other industries and sectors. Just on a couple of the other topics on financial instruments and hedging, I think there's a lot of great improvements that may have been overlooked by a lot of investors. I think both of those topics were in the few areas in accounting where the tail might have wagged the dog, especially with hedging. There are many cases where under the old/current rules where companies would get into hedging or economic hedging arrangements, but the accounting would be so noisy, and you'd have to work through a lot of non-GAAP measures to get to, I think what the true economics and accounting to align. And a lot of this hedging, by allowing component hedging, both on the financial side and non-financial side, I think is beneficial for both preparers and users of that information. The other one is financial instruments, particularly around now the requirement to effectively fair value equity stakes. And you've also actually seen some changes in behavior there. So an example of that is United Technologies used to take de minimis, or they call it de minimis, but strategic investments in certain either suppliers or competitors or whatnot, and potential acquisitions. And those were all at cost before, so you had no idea really what that investment portfolio looked like. Under the new standard, you would have to mark that to fair value effectively. They announced that they're no longer going to do this strategic investment. And so we've also seen other areas in healthcare, and you can think of like Google, for instance, puts money into Lyft. All that's at cost. You have no idea really what those investments are. Now that's going to be a little bit more transparent. I personally think that's a good step forward. So what we have on slide 3 here is where tax rates are landing, is what we call it. So the big $1 question is, $1 billion question, I should say, is after the reform, where are the effective tax rates landing? And so we had a team who's gone through now about 850 pieces of guidance that have come out through the year. And so this is basically an aggregation of that by market cap size and by sector. And you can see that the average tax rate for U.S. companies is gearing towards 22%. If you go to the next page, you can see how that compares. Oh, excuse me. So the next page, apologies. What I wanted to highlight is the richfulness of the tax footnote today. And what we are able to do is, after the act was passed, using XBRL and CalcBench data, is actually try to model out what we thought the tax rate would be. And so what you see right here on the left side is what our model is, and what you see on the right here is basically our error rate. And so I think this is the importance of the richness of the footnotes is there's no other aggregator that gives you pre-tax income U.S. versus foreign. A lot of the aggregators don't give you very good information on the state versus foreign versus federal level. The rate reconciliation table is critical. So I was able to go in and pull information out of the rate reconciliation table, like the R&D tax credit. I want to keep that. The domestic production deduction was eliminated, I could eliminate that in my model. And it actually worked out serendipitously very well, where we were able to basically model the tax rate to the dollar or to the cent. And how that compares with the baseline is what we looked at is the median tax rate per company for the S&P 1500. And you can see on slide 5 here, based on guidance, companies' tax rates should be reduced by 5 percentage points, all else equal. Now, again, where there's more companies than 700, but we're collecting those, I think that's a pretty decent sample size. So that should give you some sort of insight for, hopefully where tax rates are going. And again, I think that I just point to the usefulness of the tax footnote itself and utilizing some of this XBRL data. And then my wish list, since the FASB is going to be improving this footnote more, is more geographical information, right? I think it's more pertinent than ever. And right now you have federal, foreign, and state, but we really need more information on where foreign sales are generated, where foreign profits are earned, especially as we want to try to model this out going forward. And I would also chime in for the rate reconciliation table. Don't allow that to be the kitchen sink. So I think beaten guilty should get their own line item.